All right, so let's take a look at another exercise, this one balance sheets and applying the current and quick ratios. So we kind of need to know what both of those items are, current and the quick ratio. But before we get to that, we are going to populate a balance sheet here for the end of a period, September 30th, 2019 to be exact. Then we're going to consider a couple of transactions and look at how that balance sheet has changed the next day. Because remember, the balance sheet is a snapshot of a company's assets, liabilities, and equity at a given point in time. What point in time? Any point in time that we want to look at. Okay, it's not like the income statement where we generally put one together at the end of the month and then at the end of each fiscal year. Okay, so we've got some balance sheet information here for this company called Brownlee Catering. And so when I see a question like this, and we've had one kind of similar to this before, except we were constructing balance sheets and then we were calculating working capital, which is working capital is a dollar amount. Whenever we see the term ratios, we're going to be dealing with a non-dollar amount figure. Okay, it'll be a number, but it won't be a dollar amount. Okay. So let's just see what we have here. Remember that the balance sheets were ordered first in terms of current assets in order of liquidity. So starting with September 30th, 2019, we have a grayed out box right here. That means we need to put something in there that is an asset. So we want to look up here and find the most liquid of all assets. Why? Because it's at the top. And that's how we do that. And that would be cash. So we would choose cash probably from a drop-down box. And the amount is $10,000. Okay. And then our next item, they give it to us, is accounts receivable. And so all we have to do is just come up here and put this figure in. Then supplies, inventory, same story. We have $9,000 that we're going to plot right there. Okay, now notice that we have one more item and then we have total assets. So that means we're only going to be looking for one more asset. And so if we look up here, we do have a non-current asset called equipment. And so we're going to plot that here because non-current assets provide a future benefit that lasts in excess of the operating cycle. Okay, so that one's going to be plotted here. And at this point in time, we can go ahead and add these up. All right, so let's go ahead and do that. You got $10,000 in cash plus $17,000 in receivables plus $9,000 in supplies, which are a prepaid asset, plus $34,000 in equipment. Gives us total assets of $70,000. All right. And then we have the heading liabilities, and looks like we have two. We're going to have notes payable, and then we have a box here indicating that we need to find another one. So notes payable can be current or non-current, but it is probably going to be a non-current asset. Not that that really matters for this particular question. And so we look up here and we see notes payable here, and then we look for that key word. That's not all liabilities will have the word payable in them, but if we see the word payable, that we are guaranteed to have a liability. So liabilities are ordered in terms of when they are due, and accounts payable, as a rule, are going to be due before notes payable. So use that figure right here, $24,000. Okay, and then notes payable, they have provided us that figure as $12,000. So total liabilities, I'm not going to use the calculator here, I'm just going to add 24 and 12 is $36,000. And then we have the third heading for the balance sheet, stockholders' equity. And there are two components of stockholders' equity. We have retained earnings and we have common stock. So if we go back up here to the top, now notice there's a question mark on retained earnings. They're not just going to give us every little figure, but that's okay. We don't need them to, because they have given us common stock of 27.5. So I'm going to move the paper back down a little bit, and I'm going to write common stock, and that figure was 27.5. Okay, 27.5. Well, if we think about the accounting equation, it is assets plus liability. I'm sorry, I'm messing up the accounting equation. Assets equal liabilities plus equity, and our assets are 70,000. So I'm actually going to put that into my calculator. Okay. But instead of doing this as an equals, what I'm going to do is I'm going to subtract out my liabilities, minus $36,000 in liabilities, minus common stock of 27,500 equals 6,500. And so that would be my retained earnings as of September the 30th. So I've got the 6,500 already on the calculator. I'm going to add that 27.5 in common stock to that to come up with $34,000. And then we can apply the accounting equation, and I'm just going to put this in numbers. This is for September. I'm just going to write this, so 70th and 70,000 equals 36 plus 34, and this is in fact 70. Okay, so total liabilities and stockholders' equity equals $70,000. Okay, great. So I'm going to go ahead and clear this out here. Now we want to know about our assets on October the 1st, 2019, one day later. So our starting point for each of these is whatever it was the day before. Okay, so cash was 10,000, but let's see what we had going on here. It says on October the 1st, we purchased additional equipment costing $11,000, giving $3,000 cash. Okay, so let's put our $10,000 in here, and we're going to subtract out the $3,000 down payment, minus 3,000. Okay, and signed an $8,000 note payable, so we're taking on some debt. And it says we also declared and paid a cash dividend of $3,000. So the main thing here is that we paid the cash dividend, and it was $3,000. So we're going to subtract out another $3,000 to get us to a cash balance on October the 1st of $4,000. All right. So we did not have any impact to accounts receivable. So we can merely write down that same number again. We had no impact to supplies, so we can just transfer that $9,000 over. And we did have an impact on equipment. So to come up here and say, okay, purchased additional equipment costing $11,000. So 34 plus 11, 34,000. Let me move this over here. Plus 11,000 equals 45,000. So this did change. Cash changed and equipment changed. And then since we already have the 45,000 on the calculator, I'm going to go up. So 45,000 plus 9,000 in supplies inventory plus 17,000 accounts receivable plus 4,000 remaining cash equals $75,000 in total assets. Okay. Our accounts payable balance has not changed, so we can just simply move that over, right? And then let's see here now. Notes payable amount, that has changed because it says right up here that we signed an $8,000 note payable. So we owe this, we haven't paid anything on this notes payable amount of 12, so it's just 12 plus 8. Which is going to give us $20,000 right here. And then we simply add the $24,000 in accounts payable plus the $20,000 note payable, and we come up with total liabilities of $44,000. Again, keep in mind this is a brand new business, and so we don't have a lot of transactions quite yet. Common stock has not changed. We haven't had any additional owner investments. 27.5. And so we have to determine the ending retained earnings. And so we can actually start here. I'm going to do it the exact same way I did before. I'm going to start with assets, 75,000 minus total liabilities of 44,000 minus common stock of 27.5. And so that gives us retained earnings of 3,500. And then they want to know total stockholders' equity. And so I've got the 3,500 on the calculator already. I'm going to add back the common stock of 27.5, giving us $31,000. Okay, and so if we apply the accounting equation again for October, we would have 75,000 equals 44,000 plus 31,000, and this is in fact 75,000. So there we go. Okay, we got that done, and now we need to do a little bit of work here, and we can close this video out. They want to know about the current and quick ratios, right? As of September 30th and October the 1st. So we've got 4 boxes here that we're going to have to fill out. So before we can do any of this, we have to know what the current ratio is and what the quick ratio is. And so the fill up for current ratio is simply current assets divided by current liabilities. And then for the quick ratio, it is current assets, so it is some current assets. And so it's current assets basically from, how should I put this? We'll say accounts receivable and up, meaning up towards the top. We're dealing with more liquid assets, and we're going to divide that by current liabilities. So oftentimes you'll see this current ratio introduced as all current assets except for inventory. Well, if we see inventory, everything from inventory on down is actually not going to be included. So let's take a look at what we have here. We we have total assets of $70,000 at September 30th. However, this $34,000 in equipment won't count. So we've got $10,000 plus $17,000 plus $9,000 in supplies inventory. And that's going to give us $36,000. For our liabilities, we only have one. We have accounts payable of $24,000. So since I don't have to add anything, I'm just going to divide that by $24,000. And I'm going to come up with a current ratio of 1.5. And that's a little bit low for a current ratio. We generally want to see that current ratio be up around 2. However, this is a service-related business, and so sometimes we see lower current ratios with service-related businesses. Okay, so let's do the quick ratio. But this time, instead of using $36,000 as our numerator, we're only going to use the 10 and the 17, which totals up to $27,000. Okay, and then we are going to divide by that same $24,000. Let's see here. Let's back up. Divided by 24,000 gives us 1.125, and it says round answers to 1 decimal point, so 1.1, 2 rounds down to 1, so 1.1 would be our answer. And we want that quick ratio ideally to be at least 1. It's 1.1, so I think we're okay given that this is a service-related business. So notice we did not include the supplies, supplies inventory, prepaid insurance. It's not there, but had it been, we would not have included that. And then we're going to do the same thing for October the 1st. We have $4,000 in cash divided by, plus $17,000 in receivables plus, and let's see here, what did I do? Did I hit divide? Let me start over. $4,000 cash plus $17,000. Okay, now we're on the right track. In accounts receivable, and then that same $9,000 supplies gives us $30,000. And I'm going to divide that by 24,000 because our current liabilities did not change. And let's see what happened there. It was 30,000 divided by 24,000. I'm not sure what I did there. Gives us 1.25. So round answers to 1 decimal point. If this was on a test, I would accept 1.2 or 1.3. My guess is that if we were doing this in a software, we would need to probably use 1.3. 5 usually rounds up. And so that's a little bit low. But again, this is a temporary change just based on 1-day activity, so it doesn't really matter. And then we're going to then take just these two assets, cash and accounts receivable, 21,000 in total, divided by the same accounts payable current liability of 24,000, going to give us 0.875, so 7 would go up, and so we would have 0.9. And that's how we would calculate those ratios.